In the last lesson, we discussed the time frame of a chart and its importance. In the current lesson, we are about to discuss the trend. The trend is the direction of the market. Given that the market moves are being characterized by a series of zigzags, a certain number of consecutive peaks and troughs are being formed. It's the direction of exactly those peaks and troughs that betray the general direction of the market. Overall, the concept of a trend is very important as it allows traders to identify the direction of their trades, whether to buy or to sell a certain trading instrument, as traders rely on the existence of a trend for a certain period of time in order to predict the direction of price movements. It's characteristic that in the market there are sayings like always trade in the direction of the trend is your friend, and do not go against the trend. At this time, we must note that a certain amount of traders trade against the trend in order to profit from an unpredicted market trend reversal. Yet that is considered from our side as very risky strategy, and we are to neglect it at the current presentation. So the trend is where the market is heading to, and it can have three directions. A, it can be moving upwards. B, it can be moving downwards. And C, it could be going from side to side. Trend lines are used to identify the directional movement of prices to market trend. The slope of the trend can be used in order to grasp the rate of price changes. Their usefulness is based on the principle that once a trend is established, it usually persists for some time. Also note that trend lines can be used to manage trades, identify entry and exit points by focusing on trend line breaks and trend line bounces. Let's have a look. The first trend we are to examine is the uptrend. An uptrend is a series of consecutive higher peaks and consecutive higher troughs. An uptrend line is constructed by connecting two or more higher lows. The line is extended into the future in order to act as a support during the development of the trend. It signals bullish sentiment, i.e. that prices are likely to increase. Traders usually look to buy the pullbacks near the trend line, while may also allow for the trade to remain open in the buying position as long as the trend line supports the price action. An uptrend line is drawn by resting on the consecutively higher troughs, and that's being done for a reason. The reason is that should the uptrend lose steam and the price action no longer marks higher peaks and higher troughs, it would have to move below the upward trend line to break it, thus signaling that the uptrend is no longer valid and the trend reversal is taking place. The second is the downtrend. The downtrend is a series of consecutive lower peaks and consecutive lower troughs. A downtrend line is constructed by connecting two or more lower highs. The line is extended into the future in order to act as a resistance during the development of the trend. It signals a bearish sentiment, i.e. the prices are likely to decrease. Traders look to sell the corrective rebounds near the trend line. The downtrend line is drawn by resting on the consecutively lower peaks. For a similar reason, the uptrend rests on the troughs. Should the downtrend no longer be valid, it would have to break the downtrend line as the price action turns higher, signaling a trend reversal. Finally, there is the sideways movement. The sideways trend is identified by drawing two parallel trend lines, with the one acting as a support and the other as a resistance, hence forming a trading range rectangle. The market is trading in a horizontal range with neither the bears nor the bulls taking control of prices, and the price action being confined between the pre-mentioned upside and downside boundaries. Traders usually buy near the lower end of the range and sell near the upper bound, like within a horizontal channel. In the current lesson, we discussed the three trends that characterize the markets. In the coming lesson, we are to discuss channels as well as resistance and support lines.